You're listening to the Limitless Wealth Method podcast. Smart ideas, real strategies, and candid conversations for business leaders. Here's your host, Jason Hilliard.
What's up, everyone? This is Jason Hilliard. Welcome back to the Limitless Wealth Method podcast, my effort to share the ideas, strategies, and insights that help entrepreneurs, executives, and investors build wealth and live without limits. If you're getting value from this, it would mean the world to me if you would subscribe on your favorite platform, watch episodes on YouTube, and share it with just one person in your network who'd get something out of it. My goal is simple: help you grow your wealth and your life, one episode at a time. Let's get into it. Today, we're going to talk about something that a lot of people feel, but very few people are willing to say out loud. Because if you're paying attention, the economy right now feels off. Corporate profits look strong, markets are holding up, GDP is growing, but at the same time, hiring feels frozen. Job searches are taking longer. People aren't switching roles, and wage growth is slowing. That disconnect is real, and it's not a mystery. Let's start with the labor market because this is where the truth shows up first. Over the most recent 3-month period, U.S. private sector job openings collapsed by more than 60%. That's not a slowdown. That's not noise, and that's not seasonal. That kind of drop is historic. And it didn't happen because companies suddenly lost demand or ran out of capital. It happened because companies chose not to hire. That distinction matters. This is not a recession-driven labor collapse. This is a jobless recovery, driven by technology and accelerated by AI. Let's be perfectly candid. This isn't some unintended side effects of innovation. This is about margin expansion. Labor is the largest cost for most businesses, and AI allows companies to avoid posting new jobs, compress multiple roles into one, automate repeatable work, and scale output without scaling payroll. This is extraordinarily attractive, especially for public companies. Executives are paid on margins, they're paid on earnings, and they're paid on stock price. So when AI gives them a way to grow profits without growing headcount, the decision is obvious. Yes, indirectly, this has to do with greed. Structural, incentive-driven greed. The kind the system rewards. This is where the K-shaped economy sharpens. AI doesn't distribute benefits evenly. It disproportionately helps shareholders, executives, capital owners, and high-skill workers who can leverage AI. And it disproportionately hurts people dependent on labor income, mid-skill white-collar workers, and anyone whose leverage comes from job mobility. When job openings collapse instead of layoffs happening, the pain is much quieter, but it's deeper. People don't lose jobs, they lose options. So your raises are slower, your promotions disappear, and switching jobs feels dangerous. That's how inequality widens without triggering a crisis. Here's something most people don't realize until they live through it. Jobless recoveries often feel worse than recessions. In a recession, things break really fast. You have policy that responds to it, and hiring eventually rebounds. But in a jobless recovery, unemployment stays low, but opportunity dries up, mobility disappears, and wage growth stalls. People feel stuck, not unemployed, just trapped. That's exactly what many people are feeling right now. Now we need to talk about the uncomfortable other side of this. The same forces that are hurting labor are helping markets. That's not hypocrisy, that's math. Markets don't price fairness, they price cash flows. AI-driven margin expansion improves valuation in 3 ways. 1, they lower operating costs. 2, they're higher, more durable margins, or they provide higher, more durable margins. And number 3, there are more predictable earnings. If a company can grow without hiring, that business becomes less cyclical, less exposed to wage pressure, and more scalable. Markets reward that aggressively. This isn't just higher earnings, it's higher multiples. And that's why stock prices can rise even while the labor market feels broken. This doesn't lift all companies equally. The biggest winners are firms with scale, pricing power, capital, data, and distribution. In other words, dominant companies. Labor-heavy service-based smaller companies or businesses don't get the same margin lift. That's another layer of the K-shape. There's another consequence of this AI-driven margin expansion that most people aren't talking about yet, but it matters a lot. AI doesn't just change labor dynamics inside the U.S., it reshapes global competition. For decades, U.S. companies have enjoyed structurally higher profit margin than international peers. That wasn't an accident. The U.S. firms benefit from better access to capital, deeper equity markets, stronger technology adoption, better managerial leverage, and scale advantages. Meanwhile, many international companies lagged, especially in productivity and operating efficiency. That margin gap became embedded in valuations. AI changes that equation. AI lowers the cost of expertise, automates management and analysis, compresses decision-making layers, and reduces the need for large, expensive labor forces. And critically, AI doesn't care where a company is headquartered. Once the tools exist, a company in Europe, Asia, or emerging markets can deploy the same productivity gains as a U.S. firm without decades of institutional buildup. That's a big deal. That doesn't mean international companies suddenly become better businesses than U.S. companies. It means the gap narrows. As AI raises productivity globally, it suppresses labor costs everywhere, and it standardizes operational efficiency. International margins can rise faster than U.S. margins simply because they're starting from a lower base. That's profitability convergence, and markets care deeply about that. If international companies improve margins and stabilize earnings and reduce operational volatility, then their valuation discounts stop making sense. You don't need heroic growth. You don't need perfect execution. You just need less inefficiency. And AI delivers that faster than prior technologies ever did. That's why this isn't just a U.S. equity story. Zoom out and notice the irony here. AI may widen inequality within countries while narrowing profitability gaps between countries. Labor loses leverage globally, capital gains leverage globally, and international firms gain competitiveness relative to U.S. incumbents. Same technology, different consequences depending on where you sit. This convergence story is another reason the AI CapEx boom becomes dangerous later. If everyone deploys AI, improves efficiency, and chases the same margin gains, then competition increases, margins stop expanding, returns compress, and the access shows up. That's when the narrative flips. People keep asking, how can the market be strong if the economy feels weak? Because the market isn't the economy. The market is a claim on corporate profits. And right now, profits are being structurally supported by suppressed hiring, slower wage growth, rising productivity, and AI-driven cost compression. Both realities can exist at the same time, and they do. Now we need to talk about where this eventually goes, because no capital spending boom lasts forever. AI CapEx, or capital expenditures, feels unstoppable right now. Every company is investing. In fact, $650 billion in AI CapEx spending in 2026 alone. $650 billion. Everyone is racing competitors. Everyone is projecting massive productivity gains. But CapEx cycles turn when marginal returns decline. Eventually, the easy gains are captured and incremental spend produces less benefit. And then costs remain high and depreciation rises. That's when boards stop asking, can we afford this? And start asking, is this still worth it? That's when the cycle breaks. So people compare this to the railroad bubble of the 1800s or to the consumer durables bubble or to the IT bubble of the late 90s, early 2000s. These comparisons are valid, but they're incomplete. AI is faster to deploy, cheaper to replicate, it's instantly scalable and heavily narrative driven. That creates synchronized behavior. Everyone spends at once, everyone builds capacity at once, everyone expects returns at once. That's how bubbles form, and that's how they unwind very violently. Here's the asymmetry. The upside of AI is front-loaded. It boosts margins quickly, it inflates valuations fast. Now, the downside comes later, where it compresses multiples and freezes hiring even more. When AI CapEx stalls, earnings expectations reset, valuation multiples compress, and labor doesn't recover, it weakens further. That's how a jobless recovery turns into a job poor slowdown. Every transformative technology is real. Railroads changed the world and destroyed capital. IT changed the world and crushed investors. AI will change the world, and it will not be immune. The danger isn't believing AI works. The danger is believing spending on AI can't overshoot reality. It always does. So no, this isn't just innovation. This is a trade-off. Higher margins, higher valuations, fewer jobs, slower wage growth, wider inequality. The collapse in job openings isn't an accident. It's the receipt. Understanding that doesn't mean panic. It means clarity. Clarity is what allows you to operate intelligently inside a system that is no longer pretending to work the way it used to. If you found this helpful, send it to just one person who keeps wondering why the economy feels off, but the market keeps trending higher. I appreciate you listening, and I'll talk to you soon.